Okay, so in this video I'm going to quickly run through what are long and short positions in stocks. So let's first consider a long position, and let's say you own a share of Apple. And let's say, for example, the price of Apple currently is $100 per share. So if the price goes up by $1, that means the price is now $101 per share. And if you were to sell it on the market, you would be able to sell it for $101 and you bought it for $100, so you make $1 profit. Similarly, if the stock price was to drop by $1, it would now be trading at $99 per share, which means if you sold it for $99 and you bought it for $100, you'd have made a $1 loss on that trade. So basically, a long position in stock is where you make money if the stock goes up and you lose money if the stock goes down. And if you're in that position, you'd say you're long Apple. Okay, so now let's consider short positions in stocks. So this is achieved by borrowing a share. So let's consider Apple again, and let's say you borrow one share of Apple. The way to actually do this depends on which environment you're in. In an investment bank, you'll be borrowing from another bank, for example. But if you're just an individual trader using an online broker or spread betting firm, if you're in the UK or somewhere similar, they will arrange it internally, so you wouldn't really be involved in the borrowing process. But this is essentially how you create a short position. You borrow a share, and for the purpose of this video, we're just not going to worry about the interest you'd have to pay on that. Of course, if you borrow something, you should pay interest, but we're just going to consider our exposure to the stock. So say you borrow a share of Apple, however you do that, and you sell this share on the market immediately. And say the price is currently $100 a share. So you sell the share on the market, you get your $100, and you hold on to the money, and you have the money, but you also have an obligation to return the share at the share at some point in the future. And the point is, you have to return the share no matter what the price. They don't care what the price is; they just want the share back. So that's your obligation. It's not to return money or anything like that; it's to return a share. Okay, so let's consider this situation. Say the price goes up by $1. And now the price is $101 per share. So if you're to buy back the stock, you'd have to buy it back for $100, and you sold it for $100. You only have $100 on you because you sold it for $100, so you're making a $1 loss on that. And then you buy the share back and you return it to whoever you bought it from. So if the price were to drop, though, for example, so let's say it dropped by $1 and the price is now $99 a share, you can buy back the stock for $99 a share, and you had 100 because you sold it for 100, so you're left with $1 profit, and then you can return the stock back to whoever you borrowed it from. And this is what we call a short position. So basically, you're now in a position where you make money if the stock goes down, and you're in a position if you lose money, if the stock goes up. We would say you are short Apple in that position.